Hi, everybody. It's Trevor Hammond here, author of Mortgages, Money, and Life with Sierra Pacific Mortgage. And I want to come to you today with a quick video lesson, number 43 from the book. There's 52 lessons in the book. A third are on mortgages and how better to borrow and repay money. A third are on how to better handle your finances, your money. And a third on how to have a better life, quality of life. This is lesson number 43. Like I said, it's in the mortgage section, and it's titled The Three-Legged Stool. So what is that? It's really a crucial planning tool when you're really trying to figure out how to best borrow money and repay money when it comes to owning real estate. The three legs are safety, liquidity, and rate of return. Now, if those sound familiar to you, those are three common terms that financial professionals have been teaching for years and years and years and years and years. What's rare and unique about how we approach it and how I teach it in the book is few people know how to apply that to real estate finance. And what I mean by that is applying these three concepts of the three-legged stool to whether or not you put 10% down or 20% down on your new house. It's applying them to whether or not you prepay your mortgage each month or invest those dollars. A 15-year mortgage versus a 30-year mortgage. Do I pay down my credit cards or do I prepay my mortgage? So all of those money decisions must go through this filter, these three filters. So let's talk about safety first. How safe will my money be when I put it somewhere? That's what it is. What is the likelihood that it will be there when I need those dollars back? Now, when you look at home equity, equity inside of your home, the difference between what it's worth and what you owe is home equity. In my book, Borrow Smart, Repay Smart, I call it house wealth. So you'll think of it as wealth and make money decisions around it. But I guess most people would say it's pretty safe, right? You know, there's a chance that your home value decreases. Okay, we've seen that happen over the history. But for the most part, compared to other places you could store your money, your initial down payment, your prepayment is pretty safe, right? So I think we'd all agree to that. Now, if I'm going to prepay my credit card debt, how safe is it if I put it there compared to my checking account or my 401k? You've got to run through that and go, which one is safest for my money? Second is liquidity. How easy can I get that money back once I put it somewhere? How quickly can I get it back? Now, let's first apply that leg of the stool to equity in your house. How easy, how quickly can you get money back out of your house compared to, say, a checking account, a savings account, money markets, stocks, bonds, mutual funds, even your 401k? If you give that some thought, what you'll quickly realize is home equity is not liquid. Very hard to get out. You've got to qualify to get your money back out, right? You got to call my team. We've got to go through the whole process of filling out a loan application, checking your credit, looking at where you work, what your income is. You've been through all that before you own a house. So it's very illiquid. Even your retirement funds, if really it was a dire emergency or a need for money, you could basically make a case that I could get that money out within 24 hours. I'm going to pay some penalties, maybe some early withdrawal penalties, some taxes, but it is more liquid. Okay, it doesn't mean it's the right choice, but from a liquidity standpoint, it's more liquid than home equity. So what that does, it helps you make that decision when you've got an extra $200 a month left over in your checking account. Do I prepay my mortgage? Do I invest it? Okay, do I pay off other debts? That's what these three legs are all about. Now, the final one is rate of return. What's the rate of return with my money? If I invest my money in this place, is it a better rate of return than if I invest it over in this place? Now, that's important because now we're switching over from emotional decisions to very logical decisions. If I take that extra $200 and I prepay my mortgage with it, what's the rate of return on that? Well, typically the easy answer is it's whatever your interest rate on your mortgage is. So if you have a 5% interest rate on your mortgage, your feeling is I just made 5% rate of return with that $200 because I prepaid my mortgage. Okay, that might be the truth. what could your rate of return been somewhere else? Okay, that's an opportunity cost you've got to think about. If I was to put that $200 into my 401k, what might that make me over the next 5, 10, 20 years? And now think about that. If I save 5% by prepaying my mortgage, but I could have made 7% over here in my retirement plan over any 10-year period. If we look back at the history, again, always check with your financial planner on these concepts and strategies. But now you're starting to see that there's a gap there, right? I saved 5%, but I lost out on potentially 7%, okay? So those are the three legs. I'll stop there. I love going into depth of each of those three legs. But they are, like I said at the beginning of the video, a very crucial decision-making process for every single person out there trying to figure out what to do with your money every month. As the money flows into the house, as it flows back out, and you're paying your bills, and you're looking at what's left in your checking account, you want to look at first, where's the safest place to put it? 2, how can I retain liquidity or easy access to my money should I need it in case of emergency? And 3, how do I maximize or get the most rate of return wherever I decide to locate these dollars? All right. So I hope that's helpful. I wish you the best. If you ever have questions, please reach out to me, my team. This is what we do every day. We want to help you increase your net worth and financial safety. So take care. We'll talk to you soon on another lesson coming to you from my book, Mortgages, Money, and Life. All right. Bye-bye.